exploring what it is and how it is impacting our lives. So, yep, let me see first of all if I am live on these parts where I have to be. Oh, yep, great, nice. Okay, so here we go. What I'm going to do here is that um, you can see there what I'm doing here. It is we are seeing um, we work on the fractional reserves already where we seen this thing. Let me show you guys what I'm talking about. We already work on this one where we see that if there is a fractional reserve, uh, then how it is going to impact the money market. And yes, we can see that this part, how maximum money it can generate if we have that uh, reserve ratio. If you don't know about it, you have to see previous videos. So we reached that point and now we have to move forward, which is again that one. Yep, here we go. So we can see here how central banks work. Yeah, we completed this part, and now okay, if this is good and why. Okay, so I just asked about if this is good, that if they just loan all of the amount which they get from the customer, then there is a infinite money supply. You can see here reserve ratio. Let me review about it, what that concept is. When someone put a money in a bank, such as I put $1,000 in a bank, then what is going to happen is that um, just give me a minute. Okay, so what is going to happen is that that money going to be loaned by bank to other person. So by the policy, they have to keep a certain amount of that cash in the bank, and they loan the rest. So if I deposit $10,000 in a bank, then what's going to happen is that bank have to keep 10% of that amount, like $1,000, and they can loan out or give 9,000 uh, dollars to someone else as a loan. So that 10%, which is the 1,000 here, is the reserve ratio. So it is implemented because if someone comes at the ATM, then they have the cash. The bank should have the cash in hand to give them when someone go to the ATM and take out the cash. And there are many other reasons as well. There are two main reasons. One is that which I mentioned, that they have to have the cash reserve. That's why they keep that much amount in the reserve. And the second part is that if they are going to loan out whole amount, then what happen is that in the money system it will generate infinite amount. So that's what we call fractional reserve banking and what it is. So let me go through again here so you can have a better idea what I am saying. I'm just repeating the previous thing, but it is a very important concept. So, for example, uh, if I deposit $10,000, so what is going to happen is that if they are going to reserve 10%, then what is happening is that let me that deposit amount going to be, that's the deposit amount at our first bank, and then they have to keep 10% of it, so they keep 1000 in the bank reserve, and then they can loan out $9000 to someone else. Other person go to the same bank and they ask for the loan, so they cannot loan 10,000 amount of my money, but they can loan around 9,000 amount of that money. Afterwards, that second person who took the loan from the from my bank, the second person go in his bank, at his bank, and then they what he did, he go there and get that loan from put that $9,000 in his bank. So what's going to happen is that in the second bank account, there is going to be the entry of $9,000 deposit. Okay, and the same thing the second bank will do, 10% deposit, and then rest going to the loan. So what's happened here? If you see that when I deposit $10,000, there is a money in the system. It is only $10,000 in the record. But when the other person came and they took the $9,000 and they put in their bank account, then there is another entry of $9,000. Okay, so in another account. So if we are going to sum up both of these two accounts money, this is going to be total around $19,000. Okay, but actually the cash which is deposited, it is only $10,000. That $9,000 is the loan, or it is generated out of the thin air. Okay, got it. So what is going to happen, the same cycle going to repeat, and then it is going to repeat, and then it is going to repeat. So that $10,000 with the 10% reserve going to generate around 1 lakh dollars in the money system. Okay, if everyone go and do the same thing, what is happening is that it is generating around 1 lakh dollars in the money system. So that's how the money is being generated out of the thin air. So there is only 10,000 cash, and the rest is like the credit amount. So, but what happens is that when someone generate a product, innovate thing, and afterwards, what is going to do is that they deposit or they repay that loan, then that credit got vanished, and then real cash added into the money system. So that's how the economy grows. But for example, if we are going to have around 0% reserve, what bank did, keep no money in hand, and then they just give away all of the amount which they have, what is going to happen? Then there will be a infinite money supply. You can see that if I'm going to go down, then it keeps going. Okay, so what is happening there, the money in the money supply increasing infinitely. But in the case if I put 10%, it will stop at 1 lakh. So that's how that reserve ratio also control the money supply in the system. So there is a cap that maximum amount can be generated by each deposit. So there have to be a cap on the money supply, otherwise money is going to lose its value. Okay, but that money which is being created out of the thin air, to have the real value, it has to generate a product which is going to create a value, which then converted into a real cash. So then the economy is going to be stabilized, and then that money which is created out of the thin air to give out the loan, just as this $9,000, it is going to be justified. So that's how the economy going is grow. So let's see a story about this thing. It is called fractional reserve banking. Yep. So we got it, and let's explore the other things what we are doing here. So yep, let's we understand this thing. This is a interesting concept, how the money is being generated out of thin air, and that's why the banks have lots of money. And we put ourselves so much grind and generate the money, and then bank just get the deposit, make the credit after it, and then they created the money out of the thin air. But there is a cap. Okay, so what's the another thing which I asked about it is that if we are going to just lend our 100%, then there is going to be the infinite money supply. Then why the bank is not giving away 100% of the loan? So we can look into this. Let me explore about it as well. There's the mark of financial literacy. You're no longer memorizing. Okay, yeah, thank you so much for good words. Okay, the short answer is more money. Yeah, that's the point, that if there is infinite money printing machine, then money loses its value. Everyone uh, have that cash, so no one is going to work for that cash. So that's why money is going to lose its value if it is in infinite supply. Okay, so that's why there is a cap, and someone who own that money have to justify with the value creation. So the short answer is because more money is not equals to more value. If banks keep lending freely forever, the system eventually creates too much debt, uh, like loan, and too much inflation, because money loses its value. The price of the things going to high, because if money value become lesser and lesser, then we need more and more money to buy the same thing. That's how the inflation works. And and too little trust in the currency, because there is lots of money everywhere. So we have an idea, I am working so hard to get that money, and they are just printing out infinite money or that currency. Then why I have to trust on that money? Because it's not justifying my effort or the value I'm creating. So the currency going to lose its value. So that's why. So the gas pedal is easy to landing, feels great at first, but it never tap the brakes. The engine overheats or earn burnout. So it is the analogy. The trade-off: growth versus stability. A recession slow. So trade-off: growth versus stability. So recession slow down. So what is it happens? Central bank. What is central bank? It is top of the bank which have which regulate the other banks. So they are regulating the other banks in a way that they have to keep that much reserve ratio when they are going to lend the money, and other rules. So the central bank is at the top. So it's like central bank defined how things going to work, or the what the policies, the main policies at least. So you can see here recessions situation. If there is situation of recession, so we can say the lower reserve ratio, more lending. So lower reserve ratio, more lending. So what's going to happen is that it's like if there is low money supply, then lower reserve ratio means that the central bank and say that yeah, you can keep less in your bank and then you can lend out the rest to other guys, so they start the business and generate more value from that loan. So short term is that when someone come and get that loan, then they are going to work, then that business is going to invest and create the jobs. So that's the stuff. But what happens is that if they lower the reserve ratio, then there will be a more money in the market. But because that money comes out of thin air, then it will lose its value. So what is going to happen is that the prices of the same commodity going to rise, because the money loses its value, it's printed more, and then there is a inflate. So that's why now if there is a boom, then I have to understand what that means. Is that it means that things are going well. I think so. That's the case. There is so much value. Then the central bank can say that you can reserve more money as a cash, and you can give less for the loan. When there is a uh, less loan, then there is lower growth, because the people are unable to get that loan from the bank and invest in the businesses. So there will be a slower growth due to it, and prevent crash, as the money is not being printed infinitely or more and more. Then the price is going to be stable of the commodities, and what's going to happen is that it will prevent the crash of the market and preserve the currency value, because they are not printing the money infinitely, because it is being justified. So that's the case. Now what's it is, think of it like the watering a plant. Too much, too little, it rise up, and too much roots rot. Means that if there is too little money, then there is almost no growth, and there is too much money, then it is going to lose its value. So that's the case, because it is unable to absorb that money, or the economy is not generating that much value as per the amount of cash is being printed by the banks. So yeah, that is central bank job, to give the enough liquidity, sunlight for the steady growth. What happens if they always keep it easy? Inflation, more money chasing the same game, price rise, same course, sorry, prices rise, purchasing power falls. Inflation means that um, the value of the currency is lost. Okay, it might be because they printed more money than they actually have that uh, valuable things. So what is going to happen, that money loses its value and prices rise, and purchasing power falls, because the money the people are earning, or the money the people have saved, becoming less worthy because of the more printing of the money. Asset bubbles. Cheap credit floods into real estate, stocks, crypto. Prices rise far beyond actual value, eventually crash. What does this mean? Cheap credit floods into real estate. Prices rise far beyond actual value, eventually crash. I unable to understand this thing. Currency devaluation, if a country prints on land too much, yeah, global investors lose faith, because they will see that there is an infinite supply of the money. So whenever they want, they just print the money. So why I have to work for that currency, which can easily get printed? So that will cause the currency elevation, or you can say the currency weakens and imports get expensive, because if someone is importing and getting your currency, then what's going to happen is, if the outsider know that your country just spends more and more money, then it loses its value. So the same product which is being imported before, such as $100, now you printed more and more money without generating the actual value. That same product will be around $1,000. So the same product become expensive because your currency devalue because of the more printing of the cash. So that's how it's work. Debt addiction businesses. Yeah, there is one more thing is that debt addiction. What's happening is that business and consumer borrow recklessly because they know that I go to the bank and then apply for the loan, I will get the loan. Then why I have to work for the money? So there's a debt addiction, assuming money is always cheap. I go there and just get the loan. So what happens is that it loses the value and also get uh, cause the addiction, which is not good. And people lose interest to work and, and generate the real product. So that's why it is bad as well. So that's how it is. Real world examples. What it is. 2001 and 2008. Yeah, there is the fresh recession, very low interest. What is happening is that banks are just printing the money, maybe because they are keeping the cash less in their vaults and giving away more to the businesses easily. So uh, what happened is that a very low interest, that's the same case, and easy money, money is everywhere. Then what's going to happen is that might be housing boom crash. It's like housing price goes up so much because the cash they are giving for that house is not that much worthy than the actual house. So that's why there is the crash, because money loses its value. Okay, and then 2020 and 20 COVID estimate massive liquidity injection, quick recovery, record inflation. I unable to understand that. What does this mean? And central bank tightening, slower growth, but stabilizing inflation. So central bank alternate between losing growth and tightening symmetry is cyclical. So yeah, the same thing we just understand about the inflation and other stuff. Why they don't keep it permanently good? Because money creation is powder mirror, not daily nutrition. Antibiotic, the analogy fixing fixes infection, but overuse creates resistance. Inflation like this, if they just go and print the money, then it loses its effect. Okay, people stop working because they know that there is a infinite money supply. So the lesser value they are going to generate. Reserve curves, easy credit, jump starts economy, but overuse destroys trust. So it means that if you get the loan easily, then you can invest that money to get the work done or start the business. It is good to get things started, but if it is continuous and the money is usually get available whenever you want easily, then it will loses its value over time, because everyone knows that same thing. Why have to work so hard for the same money uh, if if I can get it with less effort via loan? So that's the thing. Founder segue, when liquidity is high, scale, fundraise, expand. Okay, it means that when we are working on a business, then what we have to do is that when we have the cash, more cash availability, what we have to do, we have to use that cash to scale and fundraise and expand our businesses. But we have to know that that money supply which is coming now easily, it not going, um, it is not permanent, it is short time period, so they have to use it wisely. Then if when there is the less investors and less cash in the market and invest loan, then what you have to see that work on the efficiency, work around whatever you have, manage your cash flow well, and work more on the profitability. So when money is easy available, try to experiment but wisely and expand. And when money is tight, then you can work more on what your existing systems are and make more efficient to get more value with less effort, and and improve your cash flow by rolling the amount as quickly as possible, and and yeah, and work more on your profitability. So that's the key thing you have to work on. Okay, so we are here. So I think so. We just covered this topic about this one. Hmm. Okay, I have to see. Uh, yep. Mm, where we are. I think so. We just done. There are also many. I think so. That part I missed. Taxes, spending reserves, uh, banks. We already work on this thing. What it is? Yeah, that part. Entire bank is spending. We can go back and get more. Yeah, we are here. Central bank creates the money, then they give it to the banks, then they loan it to the businesses. That businesses have the employees, which to whom we pay, and they become the customer of the businesses when they on each sale they pay the sales tax, something like that, that goes to the government, and that tax going to be spent by the government. And yeah, we have to see this part, spending now, then how it become the reserve. Yep, that's part. So government spends, the businesses initiate the projects, such as they started the roads or something else like that. This is spending inject money into the real economy. It's the lifeblood that keeps consumption and production running. So government spend that money in building the things for in the country. So they goes to the supplier salaries project, and then reserves accumulate in the banking system. Once money is deposited into banks, it doesn't sit idle. Each deposit increases the bank's reserve, the pool of funds they hold at the central bank. Banks are required to keep a certain percentage of every deposit as reserve. You pay 10,000 of the deposit at the bank. Yeah, so same thing. Banks with the reserve to create more money. We already understand that fraction reserve banking. So it means that what is happening is that banks generate the central bank generate the money for the economy, then they give it to the banks, and then they give it to the loan for the businesses, and these businesses have the employees or suppliers, something like that. Then they pay them, and they become customers, and these customers buy the goods and pay the sales taxes. and that tax goes to the government. Government spend for the infrastructure or something like that, and they do the same thing like a business. So it goes to the suppliers or employee salary or something like that. Then what these employees or this supplier is going to deposit that money into the bank. That money which is being deposited by the employees or these suppliers in the bank will become the uh, will become like the reserve in the bank, and the bank will have the money to loan the businesses. So that's the loop cycle. Um, this is the loop. That's how the money is being rolled out. So yep, here's how it is. I think so. We already work out on this thing and understand the fractional reserve banking as well. And now, what's the next topic? Tick, 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 tick. We have. By the way, we are on day 2. You can say that we missed one day. Okay, financial system, we credit education, we got it. Banks, we got it. Yeah, we understand that diagram well. So how many moves through the economy? I am going to so I'm going to put it here. My understanding, what it is. Come on, man. Okay, and then that's the diagram, which is simple. Is that wait? Yes, that's the diagram. Central bank create the money. We can say that create money, and then they loan out, give it give it to businesses, and then the businesses pay employees, etc. Then these employees become consumer employees, etc. They become consumer and pay sales tax, etc. Okay, then tax tax get spent uh, for infrastructure like suppliers, government employees, etc. Suppliers, g- suppliers, etc. Spend money, spend money, or you can say that deposit it into the bank. The previous deposit become reserve for the bank, and then bank uh, the the generated reserve at bank, the bank going then able to to loan that money to business, and then how the same cycle going to repeat from here. It get here, to here. Okay, so now then this is going to happen here. Okay, well, I can see that this thing. If we see that money never lose one observation, money never leaves the bank. Wow, wow. Central bank on the money in other way or something similar understanding it is giving. So yeah, I think so. That's why banking system is really powerful and also give you more power. Oh, there's the key. Yeah. So guys, let's go here again and okay, income, expenses, expense, assets, liability, financial literacy, founders, income, expenses, assets, and this one. So we are going to start from here. Okay, then okay, what I have to do? I have to do. Uh, let's let's start the day 2. Okay, so we have done that day 1, and now we're starting out day 2. So yep. Hmm. Okay, now we are here. Day 2. No financial literacy. Oh, you made a king. Now that you understand how money is created and flows through the system, today you will learn how to read that flow inside a business, the financial DNA that keeps every company alive. Financial literacy for founders. To understand the language of business finance, the 5 building blocks that shape every financial statement: income, what's coming in; expenses, what is spending is; assets like system that generating the value; liabilities which I have to pay, which are not mine, and yeah, which is costing me; equity, what is my share in it. So that's it. By the end of today, you will understand what each means, how they connect, and how money moves between them like blood in a body. Okay, so the DNA of business finance element like income, money coming in from selling goods or services; income statement, Amazon's product sales or agency retainers, it is giving me as per my work. Example. Okay, expenses, money going out to operate the business; income statement. Okay, yeah, it is saying that okay, we have to cover up around 3 statements, which is the income statement, balance sheet, and the other one which Anjum Bhai explained. I cash flow, I think so, statement, but where it has to appear, it is income appear in the income statement; expenses, money going out to operate the business; income statement, salaries, ads, software rent; assets, what the business owns or control, like yeah, these are the assets. It's come in the balance sheet, how much cash you have, how much inventory you have; laptops and receivables. You have liabilities, what business owes, like I am renting something, so it's like the I I am renting a machine, so that become liability on me. So that's like, or I I have I have the loan, so it's because I have to repay it, or there is interest on it, so it's like the liability. So it's not my money, so here's how it's become the liability. So there's the case: balance sheet, loans and payables. Something like I get a book on a credit, and so I have to repay it. But I can see that what is payables are debts on business, so the liabilities are the short-term debt. Okay, yeah, it's like short-term debts a business owes to the vendors or suppliers that not pay. So something like that. Someone comes and say that, and I say that I'm not going to pay you, such as I have this book and some, and I say that okay, yeah, I will keep this book at my store, and then whenever it gets sold I will pay you. So the amount of that book is not paid by me upfront, it is going to be paid, so it become a payable thing, so it is liability. Taxes which we have to pay to the business, to the government. By the way, someone said that government is a corporation as well. Okay, like a business. Equity, the owner's stake, residual value. Okay, the owner's stake. Balance sheet, owner capital, equity. That is my capital need. This is my retained earning. Retained earnings is like I earn a profit and I keep it in the business, so it become my retained earning. Let me just search on the internet again. Retained earnings are the accumulated profit of a company that are kept by the business instead of being distributed to the shareholders. So these are the earnings. My understanding is right. If I earn a money on my investment, but I haven't get that money out of the business, I keep it in the business and keep rolling, then it becomes the retained earnings, so it increases my equity in the business. Okay, so here's how it is. Everything your business goes does changes one or more. Okay, everything your business does changes one or more of these things. If I sell more, I increase my income. If I hire more guys, then my expenses increase. Okay, and something like that. So that's how whatever my business is doing, it is just have impact overall how things are. I mean it is uh, just implement. I mean that this is and these five things have the my business activity going to have the impact on these five things, um, always. Okay, it means that one or more from these five things. Okay, so the golden equation: assets, what you own, liabilities plus equity. What the, I am unable to understand. This is the foundation of accounting. Every transaction must balance both sides. Liabilities. I think the liabilities are have to minus from the equity. I think that equation is not correct, but we will go on. You invest $10,000 into your startup. The asset goes up. Equity, you have that much. Later, you buy inventory. The amount. Hmm. Ah, Later, you buy inventory for $4,000 on credit. Assets inventory 4,000, liabilities accounts payable which you have to pay 4,000, equation stays balance, equity 10,000, asset. Okay, so it is saying that the, but my understanding is asset is the what owes, what business owns. Okay, but liability is we don't own them, we owes them, like we have to pay for them. These are not ours. But it seems like they are saying that whatever in the business, it is called asset, and that asset is the sum uh, of liability, what we get on credit, which we have not paid, and equity, which we already paid. So, however, let's move on. But I have to understand this thing because it is saying that here it seems like the asset, it is denoting like the asset is the what the whatever the value that uh, business have. But but asset generally means what the business owns. Okay, but we don't own the liabilities. How these connect to the three friends statement, income statement, P&L, how profitable you are. Okay, income statement, P&L, how profitable you are. Got it. And income and expenses, which is more like income statement, how profitable you are. Okay, income and expenses come here because when you minus expenses from income, then it will give us the profit. Balance sheet, what you own on my name or on my control, what what we owe we get on credit, or we said we will pay later. So that's the thing. And uh, assets, liabilities, equity. So what you own owes. Okay, assets, liabilities, assets what we own. Liability is what we liabilities what we don't own, but we say that we will paid for it. Okay, or we are liabilities, loan, rent. Rent come in the expense, but we are saying that liabilities might be the ones we are paying, and then when once we paid for it, then we will own that thing. Rent isn't that we going to own it, so we have to make that distinction. Liabilities and rent distinction. Okay, second thing is that asset equals to liabilities. I am just writing here to get you the idea, plus equity uh, questions. So I have these questions because I am unable to understand these concepts right now. Cash flow statement, how money actually move. Okay, a cash flow statement is like how money actually moves. So we get the income, they get deducted from the expenses, it generated the assets, and then what we don't own, but we will own it after paying for it, and what the total equity we have in the business, and what we don't have, uh, what w- the sharing in the business. So that's the thing. And cash flow is statement, so that's the thing. How money actually moves all combines together. So this is very interesting thing. So there's the key. Got it. Uh, that's the very interesting thing. Income, balance, and cash flow, how it is being combined. And income saying that what is coming in, what is going out, balance sheet, what you own, what you don't own, and cash flow, how the money is moving overall in the business. So that's how it is. Each friend tells the truth from a different angle. P&L story of performance, balance sheet snapshot of strength, yeah, and cash flow, reality of liquidity, how much cash actually you have, or how it is moving in your business. So that's it. But we will go going deep afterwards. Money movement inside a business. Here is the internal flow, micro level of what you learned yesterday. Macro level, we learned yesterday about it, like how the what is the how the banks uh, work, and how the money flow in the economy. And now we are learning that flow of the money in our business. So yep, there's the micro level. So investment loan, like asset, investment loan makes the asset, okay, used to create products, then that used to create products and services that going to be sales income, that going to generate the income sale, and that income which we get from the sale of the product, uh, that some amount from that income going to be deducted as an expense. But someone say that uh, in Urdu, 33 लाख की तो इन्वेस्टमेंट थी, 45 लाख का नुकसान कैसे हो गया? तो ये भी होता है. So we have to know that expenses should be lower than our income. So uh, we should have a profit, but we know that business go take time. However, it's a general rule that the income should be more than the expenses, so it is going to generate the profit, and then that profit tell us more about uh, how valuable that is, and from that profit you can buy more equity in the business, such as reinvest it or withdrawal back into the asset. So reinvest, if we done, then it will go into the asset. Then that asset, the system or the agency going to create a product, and then it is going to sale. And that how this is the micro money flow cycle is. Money circulate inside your company exactly like it does in an economy. You are your own mini central bank. Yeah, if you're going to point out you are doing bad, first of all, we also have to see that are we going good with our money or not. So that's the thing you have to understand. Okay, guys, so here we go. hmm Yes, we got it. Here we have. Okay, so founder mentioned numbers not equals to accounting, they are navigation. Accounting is just the language. Literacy means understanding the meaning behind numbers. Accounting is just the language. Literacy means understanding the meaning behind numbers. Ask these three questions when you see any figure. Is it creating or consuming cash? Oh, okay, yeah. Ask you when you see any figure. In the account sheet, we have to see that this thing is increasing the numbers, increasing the cash, or decreasing the cash. Is it short term or long term? The effect of that thing is going to be short term or long term. Does it increasing control asset or obligation liability? So yeah, these three things are very important, and we can just put it here. That's the main interesting thing. And yeah, money movement inside the business. We got it. And liability, golden equation, DNA. Yeah, these all things are good overall. Okay. Yep. Deliverables. Day 2 create a simple page glossary in Notion, Excel, or something like that with uh, term definition, your own example from your business, cash flow, optional, do this thing, end of the day checklist, and this is 5 concept, practice 2, balancing examples. What does mean? Build personal glossary, link each term to real numbers from your business. Okay, we will do, but there are two questions uh, we are going to ask about this. So, guys, here we go. Yeah, because there is a, I think that liabilities we don't own, rent we also don't own. So, what's the difference between them? Uh, the CFO, okay, let's break down the you will never confuse what you owe and what you pay. Liabilities and expenses. Okay, definition money. Definition liability definition is money your business owes to others and obligation to pay in future. Okay, money your business owes to others and obligation to pay in future. Money your business spends to operate, a cost of doing business. Okay, yeah, an obligation to pay in future. So it seems that that thing, if we going to pay it regularly, that product we will own. Okay, but the expense is that we are paying it to just to get the work done, such as if there is an employee and we are paying them monthly salary. This doesn't mean that if we pay them for a certain time period, then we will owe them, we will control them, and we will buy them. So there's the restriction between the expense and the rent. Like liability give you the control or the ownership of the product. Expense going to get you the work done um, for the business, and you are not going to own that thing, such as employee. What happens when you receive goods or borrowed funds you haven't paid yet, when you actually use up a resource like space and labor. So when it occurs, so when you receive goods or thing, such as I gave them, if I get that copy and I ask this supplier, okay, I am going to keep it in my store, and when it get paid, then I will pay you. So it become the liability for me. So because when I will pay pay for that product to this supplier, then I will own it. And the expense is and the expense is like when you actually use up the resource. So if I hire a person for my store, then the salary I'm paying them, then this is the resource, this is the expense. So yeah, future payment, timing, present consumption. Hmm. Timing, future payment, I will pay you later, and expense, we are consuming that resource right now. Where it appears, balance sheet and income statement. Liability in the balance sheet, which is asset, liabilities, and equity. The three parts come in the balance sheet, and the income statement have these things, I think so. Which things income statement have? Uh, what income statement have? Yeah, income, expenses, these two things, income and expenses, these things come in income statement. uh, Income, expense, and profit. And duration can last days, months, and a year. Usually covers a short period. Monthly rent, utilities. You owe a supplier $2,000. Okay, such as I borrowed that copy from this supplier and said that when I get that product sold, I will pay for you. Uh, and here you pay for the monthly office rent or for the employee salary. Then this is the expense. So liabilities, unpaid commitments, expenses, resource consumed. So that's the thing. Unpaid commitments. Okay, but I have to clear my ownership understanding about it. You rent an office and pay rent in advance for the month. Hmm? It's the expense immediately, P&L expense. You have used the office for a month but haven't yet paid the landlord. Okay, it's recorded as liability, rent payable until you pay. So it means that my understanding of the ownership is wrong then, because if my previous unpaid rent becoming the liability, so if I'm going to get that amount paid, it doesn't mean that I will start getting the ownership of that office. So that's the point. You borrowed $10,000 loan from a bank. You owe that amount back later. Liability. Okay, I borrowed that money, but yeah, it means that when I get that amount paid to the bank, so I will owe that amount. Yeah, or there is no liability on money on me, such as if I get that 10,000 loan from a bank and then buy a machine, and then that machine generate me $20,000. I paid the $10,000 from the bank from that 20,000 generated income. Then now that machine which I bought from the bank loan is mine. So here it is how I am looking into it. Okay, you pay $1,000 electricity bill for the month. You use that service. It's an expense. Okay, you receive raw material but haven't paid. That's accounts payable liability. You received raw material and but haven't paid. I rec- you received raw material, yeah, not paid, yeah, okay. I borrowed and say that I will pay it later. So that's accounts payable liability. So it seems like the amount which I already paid, it's the expense which I made, and the amount which I am going to pay in future, it becomes the liability, irrespective that it is going to be my property after the payment or not. So that's the thing, I what I'm understanding right now. Sometimes a transaction moves from liability expenses cash flow. Cash outflow. Liability expenses. Okay, let's say you receive a rent invoice for July but haven't paid, then rent payable become the liability. End of July, you recognize it as cost. uh, you receive a rent invoice of for July and haven't paid, rent payable liability. End of July, you recognize it as cost, record as what? Rent expense. You finally pay on August 5th. Cash decreases, liability cleared. That's the life cycle of an obligation. You finally pay on August 5. Cash decreases, liability cleared, and That's the life cycle of an obligation. Founder mindset. Founder. Here's the key: never mixing them again. Liability live until they are paid. Expenses live once they are used. Still, I have still owe already used. Okay, used, but what about the payment? Okay, I just use something. Then no, 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 no. It isn't familiar much right now as well, but making some sense. But I have to get it done. And both ultimately reduce your cash but show up at different stages in your records. Both, okay, yeah, they are going to reduce my cash in the end. Balance sheet snapshot: liabilities, assets, income statement, revenue minus expense equals profit. Rent expense hits your P&L, reduce profit. Rent payable sits on your bank, reduce future cash. Still, I am unable to understand, guys. If we pay the employee after the month of work done, then is it becoming the liability or expense? There are some scenarios, I think so. I'm just unable to understand what exactly that means. Okay, brilliant. Thank you. You are just flattering me. Okay, you have just touched the exact where the accounting meets real world timing. It's more about timing, like I think so. Liability and expenses. It's more like timing. If I already paid for it, it becomes the expense, and if I'm going to pay in future, then it becomes liability. But I have to clear my understanding if I'm on the right track or no, not on the right track. Okay, so let's clear. Uh, yeah, the core principle. Every salary is both expense and temporary liability depending on when you record it. Yeah, that's the thing. When you record it, the difference lies in timing. Timing is main thing. Timing, timing of of cash in and out impact the business as it turn the things from expenses to liabilities, etc. So yeah, I think so. Timing is very important. Okay, so so here we go. Every salary is both an expense and temporary liability depending on when you record it. The difference lies in timing, when the work is done versus the when the cash is paid. Step by step example. Okay, scenario: your employee works through October and you pay in November 3rd. Throughout the October, the employee is working, generating the value, but I'm not paying it. Bad boss. Okay, salary expense you owe them for their work. Income statement. Yeah? Income statement. Okay, salary expense, but throughout the income statement, but I haven't paid. End of October, not paid yet. You now owe the salary but haven't paid. Record it as liability. Salary is payable. Balance sheet. Hmm. It's coming now in balance sheet. Okay. Okay. Number five, Payment day. You pay the employee, liability decreases, cash decreases, balance sheet only, no new expense. Okay, I think so. I am just stressing it out, but I am the guy. If I unable to understand it well, I keep stretching. So, yeah. October 31st, salary expense $1 lakh. Oh, sorry, 1 lakh rupees. Is expense October 31st. Mm, salaries payable, balance sheet. Number 5, pay employees, cash decrease, uh, asset decrease, salaries payable decrease. So the expense was already recognized when the work is done was done. The liability only exists between this one. The time gap before payment. After paying, both are clear, no duplication. Hmm. What this means? It means that in the month of October, the amount in that month of October, we are going to record that amount as expense. Okay, and after October, we record that amount as liability till it is paid. But the question is that do we keep that record or not on both sides, in expense or in liability? So yeah, think of it like the moment your team earns their salary, you have an expense. The moment you haven't paid yet, you also have a liability. Once you actually pay the liability itself, expense stays record. I think so. It means that okay. I will clear my this understanding. In business terms, expense salary, the cost of the labor that produce value during that period. It reduces your profit. Liability, salaries payable, the promise or obligation to pay that cost later. It temporarily sits on your balance sheet until paid. Okay, has the work already been done? Yes, expense. Has it uh, done? Expense. Has it been paid yet? No, liability. Both can coexist. One records cost, one records debt. This record cost, this records debt. Okay, example from your business. Okay, yeah, you have three virtual assistant of working for October. In October, each earns $500 per month. You pay them on November 3rd. A record one salary expense and one salaries 1500 salaries payable. So when you transfer the money, your payable become this one. Your cash decreases by this. Your profit for October reflects the real cost of running your operations even before cash moves. Your profit for October reflects the real cost of running your operations. Your profit for October reflects the real cost of running your operations even before cash moves. Okay, I have to visual diagram how showing how Okay, but I have to make this understanding. Uh, from October 31st to November 5th, do their two records simultaneously exist and exist as liability and expense is isn't this double entry? I'm making some sense, but let's see what it is. Just, just wait for a minute. Hello, hello, hello. Yep. Okay. So here we go. Excellent. This is a kind of question separates smart operator from a financial literate founder. You are absolutely right. With universities explain liability are recording the 7th October and they feel that application are not a double entry why both coexist and not double entry. The in accrual accounting, a global standard. Accrual is interesting concept. You record the expense when it happens. Okay, okay. You record the expense. Uh, you record the expense when it happens uh, and the payment when cash moves when actual moves. Okay, in accrual accounting, the global standard. Okay, you record the expense when it happens, the expense when it happens, and the payment when cash actually move. So it is explaining the accrual accounting definition. These two different dimensions, one affects profitability P&L and one affects liquidity balance sheet. Okay, one you record expense when it happens, even we haven't paid for it, but we record it because we hire a person and we say that we are going to pay you that much amount after a month. So the expense going to record that we have that expense. Now, in the payment when cash actually moves, when we paid that employee, but there is some confusion. Okay, those are two different dimension. One affects profitability, one affects liquidity, balance sheet. They are connected but not the same. Okay, so one affects profitability, one affects liquidity. Think of the system as two books talking to each other. Profit and loss, how much value was consumed, work done, record expense. Balance sheet, what is still own, haven't paid, record liabilities. So when the October ends, the P&L says this were cost me $15,000, $1,500. The balance sheet says I haven't yet paid that. Okay, P&L say what it cost and how much value was consumed, what it cost. P&L said these are two statements. So that's why the same expense the same amount is telling you what it cost me, and balance sheet said me what we have to pay and paid already. So there's the balance sheet told us. So I haven't yet paid. They complement each other. They don't duplicate. You are not counting two expenses, you are recording one cost in two dimensions. Yeah, well, these are two different balance sheets, so that's why there isn't two recordings on the same sheet. Okay, here's the exact double entry, the right kind equilibrium. From salary expense, this one. Okay, okay, so there's the thing. Okay, uh, and salary expense, we record debt and salary payable. We have that stuff. We have to debt and credit. Yeah, debt expense increases increase cost on increase obligation on bank. It's like we have to pay for this thing, so it increasing that thing. And credit payable increases obligation on balance sheet. So we credit here, it means we take like a loan, we take the credit uh, of that one, so we have to pay for it. So that's the thing. Profit goes down by this one, liability goes up. This one, this profit comes in the P&L, this comes in the balance sheet. Cash unchanged, not yet paid but recorded. Add family first. Salaries pay. Salaries payable. Okay. Payment made. Salaries payable expense. Salaries payables debt. So we cash account in bank credit. There is another confusion coming up, debit and credit. However, results like you paid, the liability goes down. Okay, and cash goes down because you pay from it. No new expense. It was already recorded in October, so it recorded in the October, but the liability uh, now removed. Okay, so now both sides are balanced. Cash. Why this is true? Double entry, not double counting. Is it double entry but not double counting, because this is happening in two different sheets. Every accounting entry always has two sides, debit and credit. Double entry, double entry means every transaction affects at least two accounts, not counting twice. Every accounting and every accounting entry always has two sides, debit and credit. Every accounting entry has two sides, debit and credit. Yeah, that's another thing I have to work on. Yes, another question arises. What is debit and credit? What is paid and loan, etc. So it's really confusing stuff, man. The expense and liability record the same transaction viewed from two angles. The expense and liability record the same transaction viewed from two angles. These are the two different angles, but not the two different entries in the same sheet. Analogy: when you borrow money, your cash increases. Okay, we I borrow the money, cash increases. Your loan payable increases. I have to pay for it. So two records, one reality. Same logic with unpaid service expense, cost incurred, liability is still unpaid. So this is cost incurred. We already incurred that cost, and if it paid or not. So liability is saying that if that cost is paid or not. So expenses that we already have that cost. Okay, we already use that resource. Now, if that resource is paid or not, it will be explained by the liability. Yep, got it. Founder insight. Profit and cash tell different profit and cash tell different truths. Profit shows the economic reality. Okay, work done. Cash shows the financial reality. Money moved. Profit and cash tell different truths. Profit shows the economic reality. Okay, work done. Cost. Cash shows the financial reality. Okay, so from October 31st, when your profit already reduce expenses. Okay, expenses already reduced, expense are recognized, cash unchanged because you haven't paid. Liability temporarily exists until you pay. Once you pay, cash decrease, liability disappeared. Okay, got it. That's how accounting keeps your books honest, no matter when money moves. So, okay, would you like me to show the visual? I'm getting the understanding about this thing. So here I get the better understanding, man. I get these two terms now. I have to solve these things. I have to understand these three concepts. What? I know what I need to solve them, man. Okay, so these are the two things, which is wait, it is. I think so. When I get that understanding, so here. However, I got this thing. Let me write here. Ability, liability told us what we have to pay. Cost, what value. Ah, I think so. I just not sharing with you this thing. We got it. So liability told us what we have to pay, cost or value we consumed. It isn't told us if we paid that cost or not. So the liability tell us if we paid this cost, if we paid this cost or not. So distinction, cost, cost. No. It's like expense. Expense until us if we paid that cost or not. So the library tell us if we paid that cost or not. Say that we paid this expense not. So that's the key. It's just telling us it cost us, expense telling us it cost us, the liability telling us if he paid that cost or not. So that's the thing. And it remains in the uh, income statement meant of that time period when the cost occurred for that duration. It remain in balance sheet till the amount is paid and get dis disappeared when that amount is paid. So it's like it's paid. Okay. So yep, we got this understanding. Timing of record and remaining in the books. Wow, got it. Oh. Okay, so that's the distinction. I think so. We made that distinction now. Interesting thing, interesting concept. Yep, the liability and uh, timing of record. So it's interesting, man. Got that understanding. So we got this thing. If I am going to give you the example of it, which I have, uh, if an employee work from October October 1st to October 1st to October 31st, then at October 31st, first, the salary of that employee be, uh, become expense of October. That salary is paid on first. No. On 5th November, then expense. So it will record as expense. Okay. Okay. So expense. So the salary regarding expense in October period. Okay. The salary is not paid. Then it's paid then from uh, October 31st 31st to November 5th, it will be recorded as liability as well in the balance sheet. Period in the income statement. Statement, okay? The income statement. The income statement. So that's the thing. Uh, Now we got this thing. So after 5th no November, the this salary liability will be removed from the balance sheet. No, the balance sheet. So yep, that's the thing. Uh, yeah, it will remain always in the income statement of October, despite it is paid on 5th November. November. So yeah, hopefully you got it. What this means. If you have any question, feel free to ask, and I'm happy to answer. If I know, if I don't know, we will do research together about it. So there's the interesting thing. Anyone else? If you have a question, feel free to ask about it as well. So, yep. Now we are going to have the understanding about this expense or something like that. Now we have to do some hard work, but there is another concept which is remaining right now, which is the asset liability and equity equation, because I think that asset means what we own, so it's like equals to equity or the profit, but why the liability is coming here? So we have to understand this thing, if I am right or wrong, or what is in reality. So yep. uh, mm, so here it is. Why we have to ask from, okay, so is this equation right? Because if we is this equation right? Because it seems wrong, because the liabilities is coming under asset. Hopefully, ChatGPT is smart enough to understand my vague language. Thank you. Mm. The user seems confused about the equation ability. They might be misunderstanding the balance sheet layout where liabilities aren't under assets. It's important to note that assets are financed by liabilities and equity. I will clarify by explaining the equation with an example and possibly showing a simple balance sheet to make it clearer. The user seems to need help understanding how the balance sheet equation works. I will stick to a friendly, clear tune, maybe with casual Punjabi style, to match their preference. Punjabi style. Like, oh man, I will use simple tables. Yeah, and explain that assets should be on one side while the liabilities and equity on the other. I will also include some simple formulas. Yeah, that's really, my browser really sucks now. Okay. So explain the that assets should be one side and liability. I will explain include simple formulas to ensure everything balances out. I will explain to the user that in a stacked format, liabilities aren't actually under assets. It's just about my browser is really it's hanging, and because it's become too long, I think so. That's why. Okay, I will explain to the user. I will explain to the user that in a staked format, liabilities aren't actually under assets. It's just about it's laid out, how it's laid out, not a logical connection. I will walk through the connection. Okay, go man, go. We don't have so much time. We have to conclude this thing, and I have to make a sheet. My browser is not working properly. I don't know why. I don't know why. I don't know why. Don't know why. Okay. That's it. I think so. There is a problem. I good casualties. Okay, you thought a lot and hang my computer as well. Okay. The equation assets and liability is 100% right. Okay, yeah. It doesn't mean liabilities sit under asset. It means everything the business owns asset is financed by two sources: money you owe, you get, okay, and the owner's claim, equity, investment, sweat equity, something like so. Money you owe. Liabilities are not a type of asset, they are on the other side of the equation. Okay. How to lay it out so it never feels under assets. Two columns, classic balance sheet: cash $6,000, inventory $4,000, total assets $10,000. Cash, okay, inventory, assets. I have that cash, I have that inventory, these are assets. Okay, yeah. Liabilities, accounts payable. Okay, it means that we have cash in that form. We have the inventory. Okay, we have inventory, we have cash. We have inventory. Okay, these are two types of values which we are recording. We are not saying that we own that cash or inventory, or we own that inventory or cash whatsoever. We don't telling the here in essence that we own this thing. We just saying that the business contain that value. Now we are going to say that what we own from that value, what we don't own from that value, which the business contain. Okay, so accounts payable, we borrowed the inventory for that word. I will keep that inventory at my store, and then when it is gets sold, I will pay to the supplier. That's my dealing with supplier. So it's like that. It's a accounts payable. Okay, and also that we get the work done from someone and we haven't paid, then it comes accounts payable because we have to pay that amount. It can be in a form of inventory or salary or rent, something like that, but it means that we haven't paid that value amount. Okay, and the other thing is that bank loan, we get the loan from the bank, which is the cash. Okay, yep. So $2,000, so it becomes liabilities like 2000 5000. Owner's capital, which is owner's capital, okay, which is which is the owner's money. So this is the what they own, retained earning, the profits they earn, they keep in the business. So it's become the ownership. So these ones, bank loan and accounts payable, they don't own. So it means that they owe that one from that asset. So it becomes a liability, and that owner's capital and retained earning the owner owns, so it becomes equity. So now here we are telling about who owns which thing. So okay, so that's the thing. Notice $10,000 and $10,000 assets on the left, liabilities, equity on the right. Okay. Notice $10,000 asset means, okay, now I got it. Asset doesn't mean that what we own. It means that what value we contain or what value the business contain. It now when we want to know that, okay, the business contain that much value. Now how much value the business own and how much value the business borrowed. Okay, they don't own. So now we divide that ownership stuff in liability and equity. That's the thing. That's the point. Okay, guys, now I'm understanding this unique stuff. That's making some sense. A stacked one column is also okay. Just separate clearly. Okay, stacked one column. Section 1 assets, subtotal, and section B liabilities, subtotal, equity, subtotal. Okay, total liabilities, equity, ensure it uh, equals assets. Okay, why they are equal and never double. Okay, so every transaction hits both sides, double entry. Example, you take a $10,000 loan, cash asset, plus every day, why they are equal, never double. Okay, you take 10,000 loan, cash asset, 10,000. Okay, loan payable 10,000. On payable 10,000, you earn 2,000 profit, cash receivable asset, equity okay, it is telling you how you are adding the amount now, but we get the basic concept. Asset tell us what value business contain, and liability and equity tells how what is the ownership of that value. So that's how it is. Cash receivable, equity, ouch, ah, equity retained. Okay, yeah. So it's something like that. If there is a, if if there is 10,000 comes into the business, then it is going to be added into the asset, no matter what, because it gets into the business, so value increases. But if that business owned that 10,000 or not, then it will be defined by the liability and equity. So it is spread out like this one. And then as here that cash is loan, so it comes into the liability. And if they earn the $2,000 from the profit and they re-inject it into the business, the overall value of the business or the asset increased. But who owns that $2,000? Then it comes into the equity because it is a retained earnings. So that's the key. So assets grow because either you borrowed liability or earned. Uh, you earned, but got it, man. Got it. Got it. Uh, earned, put in capital. Quick Excel guardrail. Sell for total assets. Sell of total assets. Okay, got it, man. Check the total assets should be zero. Conditional formatting. This one liability is not assets. The equation says assets are funded by liabilities and equity. Layout confused because it takes format fixed with clarity. And yeah, yeah, you are smart enough now. You just cleared me this thing. Let me go and here explain. Answered. Okay, so I think so. This is the balance sheet equation. This is the balance sheet equation. So asset means, oh, how or much value value business contain. Okay, that's enough. So okay, left side of equation tell us how much total value the business contain. Okay, like how much uh, how much water the bucket contains. But this isn't tell us who owns this water which is in the bucket. Okay, now right side of the equation tell us the ownership of that value that business contain. Yeah, got it. So liability tell us, so liability uh, tell us that value someone else contain equity. You can tell us that you can say that amount of value at amount of value, okay, business owner contain. Ah, got it. So that how it is. So the asset, liabilities, and equity comes in balance sheet. Got it. Okay, so we get that understanding as well. Nice, nice, nice. And where is answered? It is this one. Think so. That one gun. Ah, तुक्का ही यार ये. Oh, it's really. Oh, I think so. I have to take some rest, and then we will start out after some time. Uh, because there is some more. Yeah, I think so. We are done with these concepts, and there is one more thing which is debt question, which is the debt and credit. We can go into this now or later, but I think so. We can go in now, but I think so. We have to take some break, and afterwards we will start it again. Okay, guys. So that's it. We will resume it after a break. Thank you.